Good afternoon, everybody, and welcome to today's webinar. My name is Heidi Salati, and I am the Director of Education and Training for PHCC National. Today's webinar, the 10-Step Strategy to Profitably Buying and Selling an HVAC Business, is brought to you by Viga, our webinar series sponsor. Before we get started, please note that your mics are muted, but we encourage questions by using the questions box in the lower right-hand corner of the GoToWebinar window. We'll make sure we get to them at the end of the webinar. Your presenters today are Brian Cohen and Fred Silverstein of SF&P Advisors in Florida. So I'm going to hand it over to you, Brian and Fred.
Thank you, Heidi. We appreciate it, and thank you very much, PHCC members, for taking the time to join with us this afternoon. We appreciate it. We do expect to give out a lot of content here today. You're also going to see on this first slide the contact information for myself and Fred. We are available after the presentation, or obviously whenever you find some free time. If you'd like to send us an email or make a call because you have additional questions on information we've gone over, or basically anything that we can help you out with, we'd be more than happy to go ahead and do that. With that being said, I want to pass everybody over to our President and CEO, Fred Silverstein.
Thank you, Brian. There's our contact information once again. So on this slide, this is going to talk about what we're going to cover today. We're going to talk about our background and qualifications, show some recent deals in the space, talk about the M&A market, talk about mistakes you guys make as potential sellers, give you an overview of the sell side process. Numbers really matter. We're going to talk about the importance of accounting, give you some examples of things that we've seen there where mistakes are made, and talk about things that you can control that affect the multiple and affect the valuation of the business, and then we're going to talk about things that you can't control, and interest rates and that, and finally at the end we're going to open it up for some questions and answers. So SF&P was started in the year 2000. We've been at this now. This is now our 19th year of partnering with contractors. Prior to myself starting SF&P, I worked at a company called Blue Dot Services. Blue Dot, back in the late 90s, was one of three consolidators like Service Experts, like ARS. We used to have these weekly meetings, these ARC calls, Acquisition Review Team, and it was a little bit, we were all trying to bid to get these contractors in the fold, and we were bidding against each other, and it was a little bit like the Wild Wild West. I've waited a long time to see what I've seen there, but we're back into having lots of buyers interested in the space, and we're seeing multiples rise as a result, and we'll get more into that. But collectively, my team's got over 50 years of combined experience. The outlook remains very strong. Last year alone, we did $193 million, and that was in 2018. This year already, we've closed 4 deals, 4 transactions. We have 2 more under LOI. We have 3 that we're in market with right now, and another half a dozen or so that will soon be in market. So there's certainly a lot of activity, and we're excited about the prospects and go from there. So on this slide, you're going to see a lot of the deals that we worked on ourselves, and this is a list of our transactions. Horizon Services up in the Northeast, they partnered with Sun Capital. That was at the time, $135 million transaction. Since that time, Horizon has done 8 add-ons. We've helped them with 4 of those add-ons. We did the Gettle transaction with Bomb Capital Partners. That was a July 2018 transaction. If any of you guys out in the West Coast have heard of Gettle and Ken Goodrich, you know the story of the little boy holding the flashlight. We helped Ken with a successful outcome where he sold a majority interest in the business, and he's still there running it today as a minority partner and continuing to grow with the Bomb Capital guys. We did a big mechanical transaction last year, Dillon Group. That was in Indiana, in Logansport, Indiana. We sold them to Comfort Systems, which is a big strategic public company. I'm sure a lot of you guys have heard of them. Downhauer is another private equity deal. We helped them partner with Trivest. Cool Ray and Mr. Plumber in Atlanta. They're now the part of the Wrench Group, and we were the guys who got them into the private equity game. So there's a list of some of the deals that we've worked on.
the industry outlook, we're incredibly bullish for 2018, and fortunately, unfortunately, moving into the next year, we do expect to see some headwinds going into an election year. After 2019 is out, obviously things should clear up for 2020, depending on which way the election goes. But there is a large tsunami of cash about to flood the stock market, so we've been hearing that a bunch for next year as well. Currently, we do see multiples, on the rise, and as Fred alluded to in the previous slides, there are a growing number of buyers that continue to enter this space for HVAC, plumbing, mechanical, and industrial contractors. We're going to go over a couple of those in just a little bit to give you an idea of kind of what some of these transactions look like.
Our office gets 2 to 3 cold calls a week from folks in the private equity sector who are looking to get into the space. So now let's talk about some of the mistakes that you guys make in terms of mistakes made by sellers. What happens when you get into a process and you decide to sell your business, and I've had companies say, look, it's the same business. We've had weather, it's a once in 100-year weather event and things of that sort. But the reality is when you get into a process, your results get magnified while you're in that process. So it's very important for you to stay focused, to run your business so that, the results, if anything, go up and to the right and not down. And so that's, a very important aspect. We see it all the time. Guys get into a transaction, it's diligence, doing a deal, it's a lot of work. And so they tend to, they get distracted basically and results suffer. And we're here to tell you, that's the one time you really don't want your results to suffer.
And understandably so. If you've gone through a transaction or have some friends that have gone through a transaction, when you get into that diligence period, it's almost like you're rounding third base and heading for home, and you can almost feel the check cashing into your account. And it does become very easy at that point in time to start to forget about some of the things you've done so amazingly well to get you to this point. So the most important thing, as Fred said from before, is keeping your eye on the business and continue to run it in its normal course.
So one of the things that we saw in one of the 8 deals, and I won't mention the company or the transaction specifically to protect confidentiality, but we had a transaction last year. It ended up closing, thankfully, but it certainly raised some eyebrows. We had a seller on the way out, and he decided, he'd owned the business a long time, and he was leaving the business and moving on. And on his way out during that last month of his stewardship or his ownership, he decided to give, a lot of raises, and obviously the buyer found out about it, before it closed, and it effectively changed the numbers that they were buying, and it had a pretty material impact on the EBITDA. Deals are valued on EBITDA, earnings before interest, taxes, depreciation, amortization. We'll get into that more later, but you gotta, the lesson here is you gotta continue to run the business in the ordinary course. We constantly have sellers saying, hey, I need a new vehicle, or I want to do this, and my attitude is really simple. A transaction is not done until you sign and the wire hits your bank account. Until then, you should continue to own the business as if you would always own the business. And it's very easy when you're entering a transaction to say, well, I'm not gonna buy vehicles right now. Any sophisticated buyer is going to look at your CapEx and he's going to see that you're not buying vehicles, and that's going to become a discussion point. So it's very important just to keep doing things as if you weren't selling it. If you do sell and the transaction goes through, great, that's the gravy. But keep operating it as if you're not going to sell it. Number 3, it's not understanding both levers of the deal. Buyers, at the end of the day, what matters is the enterprise value. Well, the formula for enterprise value is it's the EBITDA times the multiple. And so everyone always gets so caught up. I can't tell you how many times a week I'm asked, well, what do you think the multiple is in our deal? And what do you think our business would trade for? And I always like to say, well, what's the enterprise value? Don't get so caught up in the multiple, because it's really 2 levers, in EBITDA and add backs and things that affect your EBITDA are just as important as the multiple. So, it's you got to understand that it's really 2 parts of the transaction. 4, not understanding the legality of the entity that you are. There's S corps and there's C corps, and a C corp, it's pretty limiting on the transaction that you can have. You can only sell the stock on a C corp, so otherwise you'll get double. If you sell assets on a C corp, it'll result in double taxation. So it's very an S corp definitely has more options, but understanding how the legal entity that you are definitely affects how deals are done. What a sophisticated buyer is looking for today are the KPIs, the key performance indicators, how you are operating your business daily. They want to see, how you're measuring calls, how you're converting on those calls, how successful your sales guys are. So the more levers that you have for a buyer to look at in terms of how they're operating the business, it's really important and makes your business more attractive to a seller.
And with that, for the KPIs, it's really how much control do you have of your business, or how much control does your team have with your business? When you're going through a process, oftentimes there's questions that come in. You have to sit with your team, be able to turn those answers pretty quickly. We had a situation about a year and a half ago where a call count question came in for a company in the Northeast, and it took the seller almost 2 weeks to be able to get that answer back. So it became quite evident to the buyer that this particular owner did not have his grasp of the business, and unfortunately that deal slid sideways for a while before it got figured back out.
So we are constantly, given that we work transactions with contractors, we typically see guys who are aging, looking at an exit or a retirement. So that's where what we have in number 6 becomes really important. It's who's on your team beyond you, right? Who's the future leadership, and really developing a bench or we did a deal and there were 3 key pieces to the transaction. The owner used to say, I've got 3 legs to the table, and so I'm not just dependent on one person, and that helped us sell his business, and he was able to exit the business as well. So really, it's really important to think about it. Typically we have guys and they're doing a lot and they want to sell the business and they haven't developed anybody. So it's really important to develop that team.
One of the questions that we ask with respect to the what we call bench strength, take a look at your business and you can ask yourself this question. How many vacation days or how many days can you be away from the business and the business continues to operate in its normal course, or do as well, if not better, without you there? If you have that situation where, you can leave for a cruise for 2 weeks, or, head overseas for a month and do some sightseeing, and your business is, keeps moving in the right direction, then it sounds pretty obviously like you have the right bench in place for you. And that becomes important because, like to what Fred said, these buyers that come in, they're looking to take you out and keep your bench, your other folks in place to continue to move the business forward. So, food for thought.
Nobody is, there's this perception out there that a buyer is going to come in and he's going to make all these cuts to the business, and couldn't be further from the truth. What buyers are doing is they're looking to improve on your business. They want to take your business, whatever your business is doing today, and make more money, more revenue, more profits. So they're looking to expand the business, not to have it go backwards.
Which sometimes can give even bigger opportunity to your folks that are staying on board post-transaction, which the expectation is most of them, if not all of them, will be doing that.
So the next one is really not understanding the process you're going through. I've said this before, is going through diligence. Once you negotiate a letter of intent, you have the framework for a deal. It's a very big milestone. But it doesn't really mean anything, right? So what matters is ultimately either the APA, the asset purchase agreement, the stock purchase agreement, negotiating that, and then ultimately closing. But the letter of intent does set the framework. And so once you sign an LOI, you get into diligence, and we'll talk more about this later. But my point is diligence is like a colonoscopy without the anesthesia. And if you don't understand the process that you're about to go through, it can be very challenging. Numbers play, a huge role, but it's more than just the financial numbers. It's what type of insurance did you have? What are the benefits that you're offering your employees? What's the IT system? Have you complied with all the applicable taxes? Payroll, local, municipalities. So that legal. Are there any legal issues that affect the business? So there's several different work streams that you look at as part of diligence, and it's a lot of information. And then I always say, head down, keep your eye on the prize. There is a prize at the end of this, and it's very important to go through. But a buyer's not just gonna write you the check and say, oh, you told me the business is making $3 million. Here's your $18 million check, and now we own the business. They're gonna do a lot of work to confirm. It is confirmatory, but to confirm what you said and to get to that letter of intent is accurate. The mix overall is very important. Obviously, new construction businesses are going to trade at multiples less than service and replacement businesses. We do sell some project-based businesses, and we do deal with that. But obviously, the repetitive nature of the service, the reoccurring, whether it's commercial or revenue, they're going to generate higher returns on the business. Working capital. We'll talk more about working capital in detail. We've got a specific, slide dedicated to working capital. By definition, working capital is current assets minus current liabilities. But the bigger point is you don't just get to hand over the keys, turn over the business. Buyers are going to look for an average amount of working capital to deliver, and that's going to be compared to your latest balance sheet, and that's how they're going to determine working capital. The next one is not having enough service contracts. Service contracts are a really effective tool. Buyers love to see service contracts because guess what? When something breaks, they're gonna call the person they have the service contract, with, and that's going to be an immediate opportunity to sell something. So service contracts are really important, and not focusing in on them is a mistake.
And before we move on to our next slide, we know that in the last 7 minutes we whipped through stuff that we could sit and talk about with you all for days. So if anybody has any questions on any of this, feel free to email me, Brian at SFPadvisors.com. I can also be called at 954-226-3409. We will put that slide up again for you with all my contact information. We know that some of these bullet points, we can dive in and get pretty sophisticated with, and we just want to let you know that, we're here if you have any questions.
So here's how SF&P can assist. We vet your data first off. We're, depending on the size of the company, we're either going to do a confidential information memorandum. On smaller deals, we don't always put together a SIM, but we still try to organize your information so that buyers can see it in a secured data room. Before we let any buyers see anything, we get an NDA signed. If we have serious discussions with you as a prospective seller, we're going to get an NDA signed so that that your conversations with us are confidential. But if we do go through a process and you decide to use us as your intermediary, we're gonna make sure before we even release your name that we have an NDA signed with prospective buyers. So we act as a liaison, with multiple buyers. We field questions. We're really running the process. We allow you to run your business. A couple of minutes ago, I talked about how important performance is. Well, if you do decide to use us or some other intermediary, it's very important to lean on them to run the process for you so that you can continue to run your business. So we anticipate and mitigate the impact of potential issues while protecting your price and structure. I'll give you an example of a deal we did last year. We had a deal up in Boston, and we had an initial conversation and talked about a valuation with our prospective seller, and he was fairly good with the range that we quoted. It turned out that we had two really interested parties involved in that process. We were able to leverage them against each other. I took the guy who was in second place, I brought him up, pushed the guy who was in first place, and pushed him as far as I could. The end result for our client was a full turn better on the multiple. So it was a really good result for that seller. And by having multiple buyers in the game, it allows you to really get a nice price for the business.
And to that point, it's the reason why we've been chosen about 230, now 240 plus times in order to represent sellers. We have an incredibly deep pool of buyers that are interested in this space. You hire us to bring as many of these buyers to the table as possible so that we can begin to work them against each other to get the best, value for your business or price for your business.
So here's a review of the process. First thing we're going to do is we're going to compile some basic financial information. I take that back. The first thing we're going to do is sign a non-disclosure agreement. Once we have that NDA signed, we're going to ask you for some preliminary financial information. We're going to ask you for about 3 years of financials, the current trailing 12 months. So right now, if you said, February is the last month that ended, we'd look for February of 19 versus February of 18 so we can produce a true trailing 12. We're going to look at add backs at a high level. We're going to go through and talk about your salary and your rent and your personal expenses. once if you agree to sign up with us, and at that point we do a deeper dig on the ad backs and try to uncover more and really try to create some value. But for that first part, we go through and come up with a valuation. We don't want to waste your time or our time, so we feel, based on the conversations and the amount of deals that we're closing annually, we've got a really good idea on the market and what your business would trade for. So we quote you, kind of a low end and a high end range with, where we think it would land. And if that number is consistent with your expectations, then we look to move forward and do that deeper dig into the numbers, come up with some more add backs, look at your accruals, make sure you have some GAAP balance sheet accruals and that type of stuff. And then we ask you a bunch of other information that allows us to prepare a SIM and or data room. So we share that information with prospective buyers, kind of comes back and forth with us. There's some Q&A. Sometimes there's a site visit. Before we even get to a site visit, we'd like to get an indication of interest from a prospective buyer, let us know that they're worth inviting to town and meeting the management team and such. And after that, you should get a letter of intent, and that'll dictate, price and terms. I will say some buyers have said to me, man, you really over-negotiated the letter of intent. To me, I take that as a compliment. The letter of intent is the framework for a transaction. If you look at kind of the deal pendulum, the stuff when you're negotiating an LOI, it's all in your favor. They're trying to make a deal happen. Once you set the framework of the deal, it becomes a little bit harder to negotiate. So it's always good to get it up front in the LOI. Once the LOI is signed, then we get into due diligence, and that was the process I mentioned before of all the different work streams. You start getting into the legal. Lawyers exchange documents back and forth. They're negotiating, and finally, at that point, a closing date is set.
So the 10 steps to selling a business, the first thing obviously is to get your financials in order in accordance with GAAP. Should be done well in advance of a sale. It allows for the consistency in comparing, prior years. Go ahead, Fred, jump in.
So one thing I wanted to say about that, it doesn't always happen. If I had my druthers, I would love all my sellers to do a sell side Q of E. Dave Geiger of Horizon, when he sold his business, he was $135 million. He always said to me, you want to control the process or you want the process to control you? And so by being proactive and getting your numbers vetted in advance, it takes the guesswork out, and you start building a little fort around your numbers, and you have a much more defensible position. And it's really important to do that. Not everyone does that, and we don't require it. I'm a CPA, and I was an ex-auditor at Price Waterhouse, so I really look at the numbers, and we're going to try to spend some time and do a little diligence up front, even if it's just a placeholder. As an example, let's say, we look at it and say, warranty reserve should be $50,000 on your balance sheet, not necessarily a P&L effect, but just $50,000 on your balance sheet. We'd rather have that $50,000 as a placeholder, and then the buyer comes in and they come in and they say, it really should have been 60. Well, guess what? Going from 50 to 60, having a $10,000 incremental, lift isn't as detrimental as having a $60,000, impact. So we do try to spend some time and really look at your reserves and accruals and make sure that you're buttoned up. A lot of you guys are probably cash basis of accrual. Obviously, buyers are looking at this. They're going to try to convert you to an accrual basis and get you in accordance with GAAP. So the next step, and we talked a little bit about this, a few minutes ago, is really building your service contract base. Buyers love that, right? Buyers love the amount. It's reoccurring revenue, and as we mentioned, it does put a nice fence around your customer base. The next one is the marketing plan. There's different life cycles in your business. I watched Horizon, and I'll go back to the Horizon example. I did their deal in 1999 as part of Blue Dot. They were an $8 million company. I sold it back to them in 2003. They were a $12 million company, and I sold it to Sun Capital 2 years ago, and they were $135 million. So I've watched them, be in the growth phase and really go out and spend a lot of marketing to where they are now. They're in a more of a mature phase. So, the marketing expense should go down. Another example would be, Gold Medal. When I sold Gold Medal, they were coming off election year. They were spending all kinds of money on TV in 2016, and the MSA was New York, so the advertising was really expensive. They couldn't measure they couldn't measure the return on investment. They decided to, as part of going to market to redo their advertising, they saved net dollars. The numbers, stayed the same. They became more efficient in marketing. So your marketing plan, really, really matters. The next one is consider an acquisition. The more revenue, the higher the price. So it becomes really beneficial for you to look at buying out one of your competitors. There's a lot of back office savings. I did a deal when I did the Coolray deal a few years ago. The owner of Coolray had said to me, "You know what, Fred? I'm doing an acquisition. Let's hold off. Let me prove out, some of these savings." Him and I went through. It was a 5 multiple deal that he had spent. It was a 200,000 EBITDA, maybe a 5 multiple deal. We figured out that because of the back office savings, he was going to generate about $125,000 a month in profit. And we were starting to talk to some buyers, and he's like, I'm just prove this out. Let's wait a year. I ended up getting him credit for it as an add back, so I got him the credit up front. But it's very important to consider if you've got the wherewithal to do it. And I know it sounds easy for us, but buying one of your competitors and folding it into your business definitely adds value in terms of selling your business down the road. Again, we mentioned the management team. We're stressing on that bench strength, but presenting a management team with a solid bench is really significant. Buyers want to see that the business is not just relying on one person. Going back to my 3 legs of the table, it was a really good strategy, and it's something to really think about. It should be a big part of your succession plan. Technical difficulties. Okay, there we go. Number 6. And we've seen this one. We've had sellers, what we call around here, change the goalpost on us. So we want, when you make a decision to sell, you shouldn't go back and forth. You should decide what you want. We're here to help with those types of discussion. For sellers, this is their baby. It's very emotional. For us, this is what we do each and every day, and we work with sellers.
Yeah, and to that point, I think what Fred means is, you don't have to be black and white and giving us a phone call to have a conversation, to get an idea, of what the value of your business is. As a matter of fact, we think that's an incredibly smart move. It's always surprising to us how many folks we've had a conversation with that really don't know what their business is worth. So they didn't realize they could actually do something. So, don't be afraid to give us a call over here. Contacting us and saying, hey, want to get an idea of what's going on with my business. That's in no way, shape, or form an indication that you want to sell your business. It's an indication that you want to have a discussion and learn to see what options are potentially available in an exit. So back to the point that Fred was making, listen, obviously, once we're in engagement and we're moving down the path and we have, buyers that are interested in your business, we got to all be clear and on the same page what the goal is.
So be very clear on your deal objectives. And again, price is important. I often say, to sellers and such that chemistry is a very underrated part of every deal, but it's not just price, right? Price is an element of a transaction, certainly an important part, but what's the terms? Are you getting all the cash at closing? Do you want to work? Do you not want to work? We have clients, and we see it all the time, that guys change the goal line on us. So communication with your advisors is key. We recommend regularly scheduled calls to discuss the transaction, discuss what you're looking to gain.
And sometimes it's that you want to have an exit from your business or a partial exit, and you're not sure exactly how you want the rest of it to finish up. If you want to be out in a short term or in a long term, or if you want to roll equity back in, and those things are okay. And sometimes you figure those out, as the process moves forward. And if you don't know that answer in particular, it's not the end of the world. Sometimes it becomes a negotiating point that we can use on our end to make a deal better for you.
So the next one, and it may sound a little self-serving, but even if you guys don't want to do business with us or decide to hire us, I strongly recommend that you hire an intermediary. The guys that you're dealing with on the other side are professional deal makers. They will, eat you up and spit you out and take advantage of you. So it's very important that you have somebody on your side that understands, how to get a deal done and understands what your objectives are. So, the other point in all this is a lot of times buyers are going to work with the seller kind of post-closing. And if you try to negotiate that deal on your behalf directly with the seller, guess what's going to happen? That relationship's going is going to get a little bit spoiled, and so it's always best to leave the heavy lifting to us.
We had a call last year from a seller in the up north. Had a really nice business, had been around for quite some time, a nice EBITDA number, and he had said that he had a couple phone calls from some folks that were interested in acquiring his business. The challenge is they had never done this before. So, one of the owners thought that he had the wherewithal to be able to negotiate, move himself through a process. And unfortunately, he did not do a good job, to the point where he had obviously upset the buyer and the relationship deteriorated. So when he called us and told us this, one of the things we said is, realize that when you go through it, it's incredibly emotional on your end. So to be able to try and negotiate, on your behalf with your future partner per se, is a little bit challenging. It's better for you to be able to run your business and obviously let us get ourselves in between and work things out on your behalf with the potential buyer.
So the next one is again back to the diligence process, and again, the buyer is going to confirm what you've shown them this far, and they're going to do a deep dig into the financial, operational, legal, tax, insurance, benefits, general liability insurance. So having a person on the inside is key. I will say a lot of times sellers don't want anybody to know, anybody in their office to know, and in those situations, we're like, if you can't pull us all the information, it's going to be hard to get a transaction done, because the amount of volume and the amount of information that's required that a buyer looks at, there needs to be somebody on the inside that can put all that together.
And usually we find that in those scenarios, the owner has a couple of key people on staff that he or she considers confidants to be able to help them put the information together through the process. So it's just another way to get it done.
I will say, in my career, I've been many things. I've come in and been an insurance agent, a bank auditor. There are different things that some of this stuff that you could put a disguise on so that the rest of the organization doesn't know. But there are several key people within the organization that you're going to have to tell them something, because they're going to be critical as well to try to get a deal done. Finally, the last one is choosing an attorney who specializes as opposed to a generalist. Just like going to a doctor, right? If you got a foot problem, you're going to go to a podiatrist, and it's the same thing. You really want somebody who's well versed in M&A, somebody who knows their way around the transaction. I've had situations where I've worked with generalists, or I've worked with lawyers, and I'll give you an example. Again, I'm gonna protect the confidentiality in this one, but had a deal last year where I had a lawyer, and every deal's got something called fundamental reps, and those are, your basic ability to sell the business, you haven't committed fraud, you've paid your taxes, things of that sort. And, fundamental reps are typically not something that gets tripped up, right? Because by nature, they're fundamental. Well, in this particular deal with this particular attorney, he made a case about, how long the exposure, on the fundamental reps was lasting, and the buyer's point was, these are fundamental reps. They're supposed to last. So it's just a question of finding the right guy to be able to do it. So now let's talk about the importance of accounting. Again, for comparison purposes, your financial statement should be in accordance with generally accepted accounting principles. That means things like warranty, deferred revenue for service contracts, paid time off accrual, work in process, allowance for doubtful accounts, all needs to be done on time. We really recommend doing a sell side quality of earnings. This takes the guesswork out. You could do a white paper which basically allows buyers to see the results and get the conclusions up front. And accounting is out of all the different work streams, accounting is the most one, and it's the one we see the most often that trips up a deal. So let's talk about valuations. Earlier I spoke a little bit about the process and the information that we need. So we need the financial statements for valuations. EBITDA, and this again depends on the size of the company, and we've got in here a 3 to 7. We've worked on and negotiated deals certainly that are bigger and higher than that, and again, size matters, and it depends on how big the company is, but it's EBITDA plus working capital. Deals today are typically done, and it's not true for everyone, but the typical example is they're done on a debt-free, cash-free basis. So debt is going to be deducted and the assets are expected to be delivered free and clear. The flip side of that is you get to keep the cash. Some buyers, really like earnouts or some sort of conditional consideration on performance. This is a popular way to keep management engaged. And finally, we're seeing a lot of deals and have worked on a lot of deals where there's a recapitalization. So I'm gonna give you a simple example of a recapitalization deal. Let's say you've got a guy who's doing $5 million in EBITDA, and let's say that business, keep my math simple, traded at a 6. So that's $30 million. That's the $30 million in enterprise value. And let's say our seller wanted to maintain a third of the business. So in that case, it would be the buyer would be bringing in $15 million worth of debt and $15 million worth of equity. So if that seller wanted to maintain a third, 5 divided by 15 would be would come off. So he'd roll $5 million of the 30. So he would net 25. He'd have a business now that has $15 million worth of debt on it, and he'd roll that other $5 million and still own a third of the business. So working capital. This is again back to the point. You don't just get to clear out the accounts, leave the debts, leave all the liabilities, and hand over the keys. What buyers are going to do is they're going to go back. The typical way they do it is they look at the last 12 months worth of balance sheets, exclude the cash and exclude the debts, and since those aren't going to be part of the deal, and they're going to take the average over the last 12 months. Then they are then going to compare the latest month or the closing month to that average. Sometimes you may be above that average, in which case they owe you money, and sometimes they may be below that average, in which case there's going to be a deduct. Again, by definition, it's current assets minus current liabilities, and buyers are looking for a normal amount of working capital leaving the business.
So, there's some things that you can control, the internal factors, obviously, that influence business valuations. We see time and time again is the bigger your business is revenue-wise, basically the higher revenue, we should expect a higher multiple on your business. A strong year-on-year growth rate is important, consistent higher margins. What's your business mix? Listen, residential is preferred, is preferred service, preferred new construction. It's not that it's not preferred, it's just not going to get you the same multiple. So when we go through your business financials, we're going to break the business apart into its various components and give you a rough idea of when we put it back together, obviously what a valuation could look like. Strong, predictable cash flow. What's your repeat customer profile look like? Are you working with the same folks year after year? It shows a nice consistent relationship that can be predicted. One-time customers obviously are less favorable. What part of the country are you in? For a lot of you, if you understand what a DMA is, a designated market area, the bigger the city that you're in, the buyers typically look at it as a larger opportunity for growth within that area. Go ahead, Fred. You want to jump in on that?
I was going to make that point.
Okay. So, your top cities obviously make it a little bit easier than maybe one of your smaller cities. But, what it always boils down to is what's the size of your business. The larger the size, if you're a sizable company, it almost doesn't matter where you're at in the country. So keep that in mind too. Your bench strength and management team. Like this is about the third or fourth time we've touched upon this, is your ability to walk away from the business or take some time away from it and the business continues to move in its normal course. If you're a mechanical contractor, having a high backlog is important. Strong barriers to entry, for you, that becomes important. Sufficient working capital to support the business, low customer concentration. So we saw this, and this is an interesting one on a transaction that we did from a transaction from last year, is that this was more or less, you can almost call this a type of new construction business, but what we're able to prove out is that this client of ours had so many clients that they worked for that repeated year after year after year, that we're able to kind of move away from that customer concentration scenario. Do you have a strong brand name or identity in your market? Having a non-union company is important too. It doesn't mean we can't get deals done on union companies, just it seems to be easier to be able to get it done when a company is non-union. Go ahead, Brent.
I would say to that point, we actually are in a process right now with a union company, and One of the deals on our earlier slide was a company in Chicago called Dornbos, and we sold Dornbos actually to his close competitor down the street, who was also a union company. The one thing we'd say about union versus non-union is, we're certainly going to have more options for a non-union. Doesn't mean we can't sell union companies. Having your key employees, on their employment agreements and non-competes, that's obviously valuable. Not everyone has that. And again, back to the numbers, and having your numbers buttoned up is a nice factor as well. Now the next slide. Go ahead. There you go. And then here you go. No, you went too far. The next slide are about the external factors, or the things that you can't control. So good news today for you guys thinking about selling. The Fed came out and decided to keep interest rates the same. Just saw that, that obviously helps us. We pay particular attention, and the reason is really quite simple. If you go back to my $30 million example, buyer was bringing in $15 million worth of debt. Well, that's cost of capital, and how much does it cost the borrower to finance that transaction? So the higher the prime rate goes, the more these deals get expensive. If we were in a period like the early 80s, when it was highly interest rates, the businesses wouldn't support the interest payments, right? So you guys understand the businesses and how tight the margins are. So obviously, the lower the interest rates help us in terms of M&A activity. We've got a lot of buyers right now. They have what they call dry powder. They've got cash on hand to do transactions. Lots of private equity. We deal with banks, who are willing to lend on these types of assets that aren't really, hard assets. They're cash flow loans where they lend, 3 to 4 times. If you go back to the example I used earlier on that $5 million doing at 6 times, that was with 3 times leverage. So we're seeing, banks lend anywhere from 3 to 4 times. We've worked with guys on an SBA loan and different types of structure. Debt is always cheaper than equity, so it's just something to keep in mind. So here are some other deal points. We've talked a lot about the financials and such, but here's some other deal points that affect most deals. Lots of buyers want you to hold, have an escrow or a holdback, and that just allows them to be able to true up if they find anything post close. It's a lot easier for them to go to the escrow agent as opposed to go back to the seller. So it's an opportunity for them to hold back some money in case they missed anything, frankly. So the asset purchase agreement or the stock purchase agreement, we talked about how important it is to have that M&A attorney on your side to negotiate what's customary. One of the things I'm working on today, I've got a deal that's under LOI out in Phoenix, actually. And, we're through a legal process, and I've got, the legal agreement. I've read 200 of these agreements, and while I'm not an attorney, I work closely with their attorney and give them the points and the agreement that we know are customary and are within market, and try to, help the attorney along and get the things that are pertinent for their specific situation. The employment agreement, want to make sure it's consistent with the valuation, and that's, again, one of the things we look at pretty early. The non-compete, non-solicitation, different buyers, different sellers have different goals, how long they're willing to stay in. Sometimes we have, buyers typically like 5 years. We negotiate that individually depending on what our sellers' goals are. The lease, there's typically a lot of times, sellers own the property and want to make sure the lease is recorded consistent with the numbers and the valuation. It's doing a true up or post true up. That's really about working capital, whether there is the opportunity for the buyer to go in and look at the numbers post-closing and how that compares with what's in the legal agreement. That's, again, about your closing balance sheet. Reps and warranties, those are statements of facts or stipulation and how long your exposure is on those facts and statements you made, so that should usually be tied to your escrow agreement. We're seeing a lot of R&W insurance, reps and warranty insurance, in lieu of an escrow, and that just gives the seller more cash up front. So I think that brings us to the Q&A portion of our webinar. So hopefully we have some questions.
Hi, thanks, guys. Great job, and a lot of really terrific information you put out there. So yes, I do see a couple questions coming up. The first one is, I have a family-owned business. What if I don't want to sell to my son or daughter? What are my options? Can you touch on this?
Sure, that's actually a great question. So we did a transaction, similar situation in Louisville, Kentucky, the Downhauer transaction I mentioned earlier, and it was a father and a son, and it was, for the father, it was really important that the son was taken care of, and this goes into, whether you sell a majority control or a minority control, there's certainly options within the private equity community to help recapitalize the business. It allows you to take some chips off the table and reinvest the business. A lot of times we see the son as that reinvestment piece, and with the father, being able to liquidate his asset.
Yeah, and to add to that, I had a conversation a couple of weeks ago at a national event, and one of the owners had said this was the transaction that he was looking at specifically because he didn't want to be part of the business anymore. While he loved his family, his son to death, he didn't want to be in business with him any longer. It was time for the son to go ahead and stake his own claim. So he found it more fruitful for himself for the son to be a partner with the private equity group moving forward and him to be out of play. And again, he didn't want his son to be his lifetime annuity with the business making payments to him. So there's a lot of interesting things that go along with that, but we are seeing that transaction structure time and time again.
Thanks, guys. We have a couple more. The second one I'm seeing is, why are there so many transactions happening? Could this be tied to the economy?
So that there's definitely some tailwinds related to the economy. For us, what we've really seen, for a lot of times we had a couple strategic buyers, and then there was local transactions, really with private equity taking a liking of the space, and then the question becomes, well, why does private equity like the space? And if you look at some of the characteristics, right, these are services that, whether it's residential or commercial, it's not going away, right? Even in a recession period, and we get asked this question, all the time from buyers. It's like, well, what happened during the recession? How'd your business perform during the recession? And typically, we see that these businesses still perform because these are services, that are just necessary. You may have somebody in tougher times look to Band-Aid, maybe not get that replacement system, but fundamentally, at the end of the day, these are still services, whether it's a homeowner, whether it's a commercial business, they're still fundamental services, and I think private equity really understands that these businesses aren't going away.
Thank you. And another question. Can you give us some tips on planning that I can do ahead of an exit?
Yes, we actually have a checklist that we'd be happy to share, but some of the things that we mentioned earlier, such as your marketing plan and what you're doing, marketing that's a really important part of what you should be doing today. Some other things to consider is, again, building the service contract, building that service contract forward, and making sure that you have the proper amount of sales and really be building your business. There is a difference between growing and deciding to sell. You should run it in the ordinary course, but things like getting your books in order, that's getting GAAP compliant, getting the audit or the QE, or having the numbers streamlined, controlling your costs. As you're building a business and you're trying to grow it, you may not be as concerned about your operating expenses, but as you think about selling and getting a multiple times your business, really controlling your operating expenses is really important. Building that succession plan, another one that we mentioned earlier, is pretty important. How you maintain your customer data and making sure you have good systems in place, and whether you're using a software like Service Titan or that type of thing is really important and meaningful as well. And again, going back to thinking about doing a local acquisition, as we said earlier, 1 + 1 is going to equal something greater than 2.
Thank you. So
And Heidi, if I could
Yes.
jump in for a second.
Yeah, please. Go ahead.
We'd be more than happy for anybody that's on with us today to be able to send that out to you. If you want, you can simply send me an email. I believe my email address is on the bottom of the screen there, brian@sfpadvisors.com. We have that. We can get that out to you so you can have a good look at it and take a look at it internally and compare it to what you have doing with your business.
That's a great tool. Thanks for offering that, Brian.
Absolutely.
Well, if there are no more questions, we will wrap this up. I want to thank Brian and Fred for giving us their time and expertise on this webinar, and Viga for being great sponsors for this webinar. And again, you can see Fred and Brian's emails at the bottom left-hand corner of the slide. So do email them if you have any questions. And if nothing else, then we will end this webinar. Hope to see you next month for contract bonding. Thank you.
Thank you, Heidi.
Thank
We
you.
appreciate it.
Thank you very
Thank
much.
you.